Well, if you're like millions of other investors out there, you're probably questioning this recent market rally, whether or not it's topping out. Even folks making money off this rally aren't sure how much longer the Fed money printing can overcome the realities of a weak economy.
If you're among the worriers, but you still want to invest your cash, you're going to want to invest defensively, which is exactly the kind of mutual funds our next guest says could outperform the market if we do fall off this investment cliff that we're on. Jeff Reeves is the editor of InvestorPlace.com, and we don't need to get into the details because we know how worried some people are. I mean, we always like to see a rally, but you are worried about whether it'll be sustained. So let's get specifically into it. Start with your first pick, MFS Utilities. And when we say utilities, we think of gas and electric, but you say that they're sort of broadening the definition of what a utility is right now, correct?
Yeah, I really like MFS because of the reasons that you just said, that they kind of a broader definition of utilities. A lot of people don't. A lot of people know the XLU ETF that's out there, the ETF from State Street Global. It's performed pretty well last year, but it's kind of not done so well in the last 12 months. It's flat. But this particular mutual fund that we're talking about now is actually up 9% in the last 12 months. And part of the reason for that is because they've branched out into some telecoms. If you think about it, Comcast really is a utility. You got your water utilities, you got your electric utilities, and there's a lot of these telecom companies that are data utilities. And MFS has a big position in Comcast. And that's one of the reasons why you've seen some outperformance there, is because, you know, it gets creative with a definition. It's got some mid caps, it's got some telecoms. So I like this among all the utility investments out there.
Okay, and your next pick, Jeff, would be the T. Rowe Price Health Sciences Fund. Why do you think that this is a good one?
Well, just generally speaking, I think that the demographics behind healthcare, I think everybody should own it. Boomers are getting older. They need care as they age. It's one of the few almost sure thing growth stories that we have out there, aside from Apple, I guess. So if you want to take that growth to the bank, I think it's going to be very good for your portfolio. And also, healthcare is recession proof. If we've seen today, you know, the markets have kind of had a rough go at things on Monday, but healthcare, it always seems to hang tough because people go to the emergency room, they get their maintenance medications for cholesterol or for high blood pressure. So I like this fund a lot just because of the positioning of healthcare, but this T. Rowe fund has some kind of beginning stage biotechs in there as well. So you get your big companies like the United Health insurers in there, but you get some of these startups. So as opposed to trying to pick individual stocks in your portfolios, you think they're going to get this outsized growth. This diversified fund allows you to get the big boys and to get some of the small guys in case there is a high flyer.
By the way, we put it up real fast. I don't know if people saw how that thing has rallied. This thing has gone year to date 33%. Way outdoing what the S&P has done. I mean, doubling the S&P rally, which is extraordinary. Look at that yellow line there. All right, Marketfield. This is a tough one for me to figure out exactly what's in there and how they decide what goes into Marketfield. Explain this fund.
Well, I mean, the flavor for this one is the best defense is a good offense. And Marketfield is this kind of it's called a macro fund. It basically picks macro trends that it tries to invest on. And so if you want a simple explanation of what they did, they only lost 13% in 2008 because they shorted the banks, because they saw that as a macro trend, so they shorted the banks. And they figure out what's going on right now, and they move your money accordingly. Now, many investors, either if you're an armchair investor without the time or sophistication to do it yourself, you know, you can have a money manager do it for you. This actively managed fund is another alternative for you. Right now, for instance, they're big into cyclicals long, like transport stocks, and they're short China. That's where they are right now. That will change over time. And you got to have a lot of faith in the manager to do this. They have a reasonably high expense ratio of about 1.5, but that's pretty much on par with peers with this flavor of kind of macro fund investment. The performance is there. I think, you know, especially during the downturn, these guys showed that when things are getting ugly, they know how to find ways to at least preserve capital for you. Like I said, down 13% isn't great, but when the rest of the market's down 40%, it's a pretty good defensive investment to put your money in a fund like Marketfield.
Boy, excellent advice. Jeff Reeves, great to see you, Jeff. Thank you so much for bringing